Yeah.
Right.
Good evening, today's eminent faculty, CS Sachin Sastakar sir, and all the participants. A very warm welcome and welcome to the International Tax Refresher course. Today we have CA Sachin Sastakar sir, who will be taking care of a very complex topic of cross-border employee taxation. So Pune being the one of the IT hub, I would say, there are so many cases wherein we have the cross-border employees going out of India and coming into India on deputation, secondment, and things like that. So it's a very complex topic. So we thank Sachin sir for sparing his time in spite of his busy schedule and enlightening us on this a very important topic. Before we actually move on to the technical session, I would just like to briefly introduce Sachin sir. He's a chartered accountant. He has qualified in 1998. He has a degree of Bachelor of Law from University of Pune, as well as the Bachelor of Commerce. He is DISA. He is also co-opted member of International Tax Committee ICAI for financial year 2021. Member of various committees, including Direct Tax Committee at Chamber of Tax Consultants Mumbai since 2017. He is practicing chartered accountant in the field of auditing and tax advisory. He's training services for taxation, accounting, and auditing. He also has an experience as a faculty in IFA, ICAI, various study circles on various topics. He has been a tax advisor for various companies and for various inbound transactions with a special focus on permanent establishment, due diligence, mergers, acquisitions, and European investors in India. He is also representing before tax authorities, that is including CIT appeals and ITAT in dispute resolution and litigation cases. So we welcome Sachin sir for this session, and over to you, sir.
Thank you, Pranav, for kind introduction. And I understand this is the second last session of this International Tax Refresher course. And
Yes.
as the name suggests, this is a refresher course. So I believe everyone knows it. We are just going to refresh our knowledge. So Pranav, just one point, during the course of the discussion, there would be few questions from my side to make it little interactive and try to avoid a monologue.
Right.
So will the participant be able to unmute themselves and speak up, or they'll have to use the chat box? How does it go?
Swetali ma'am, can we unmute them on case by case
Yes,
basis?
sir. Yes, sir.
Okay.
So we'll do that, sir.
Okay,
Yes.
perfect. Okay. So I think thanks a lot. I think then let me just start with my technical session. Good evening to all of you, all the participants, and I was quite astonished to see, many participants were already logged in even before 5. That too, this is being a non-CPE sessions. So I think your passion towards international tax is quite evident. What we intend to do in the next 2 hours or so is to understand the nitty-gritties of a few issues which relates to cross-border employee taxation. What I would request all the participants is, let's not discuss or debate anything upon taxation of salary, which is otherwise a domestic law topic. Let's not also discuss anything on too much of a compliance related points, or anything relating to the business visa or work permit, because I'm not an expert there. So we'll try to focus more on the issues which are related to the cross-border employee taxation. And what do we really mean by cross-border? It's a simple that either a foreign company is sending their employee to India for work, or an Indian employer is sending their employees for work abroad. So it's a broadly an inbound employee taxation related points, or an outbound employee related taxation related point. With this, I know there have been, this is, as I said, this is the second last session, and I understand you already have had a series of discussion on various other topics, including, my assumption is you have already discussed residential status in detail. Am I right here? Can I assume that all of you either otherwise know the residential status well, or there has been a discussion during the earlier sessions on the residential status? Because I don't want to, I don't intend to spend much time on the residential status related nitty-gritty. So can I assume this, participants? Can you at least put in a chat yes, no, so that I get a overall understanding here? Okay, thanks. Thanks, Gopal Krishnan. Thanks, Manoj. So, okay, I think I'll go ahead with an assumption that we all know uh, the real problems with the uh, identification of a residential status. So I think with this, what I intend to do is we'll understand some of the relevant provisions of taxation of salary under the Income Tax Act, some of the relevant provisions under the Double Taxation Avoidance Agreement to set the tone for our discussion. And for you, I have selected 15 key issues based on my understanding, my experience, and let's deal and discuss finer aspects of those 15 issues. So before we begin those 15 issues, please bear with me for some basic kind of an understanding. Of course, as I said, I will not get into the residential status, but since residential status will directly hit us during the course of our discussion, I think it would be better if we spend some time here on the broad aspects. So I think these are the broad 6 situations where an individual may be a resident or a non-resident, depending upon his days in India. I'm not, that's what I said, I'm not going into the nitty-gritties of, how to compute the days, the in date or the out date, the partial, presence during India. But the point here is either a person can be a resident, or he can be a non-resident, or he can be a RNOR. Once we decide his status as any of the 3 possibilities, the next question which does arise is what exactly is going to be taxable, and how does that really impact the cross-border taxation of the non-resident. And whenever we are trying to discuss anything relating to the salary, we are of course trying to discuss the dependent personal services, which is similar to a salary kind of a situation for taxation of expatriate. The first section which comes to our mind is section 224, which tries to define the income. Then section 2 subsection subclause 45, which is total income. That takes us then to an interesting section 5, which tries to give us a total different perspective when we are discussing with income earned by a resident or a non-resident. And then we move on to section 14, which is the different heads of income, and the section 15, which is the topic for today's discussion. Now, when we are trying to discuss a salary taxable in India for a resident and for a non-resident, I think one of the 5 sections which I have noted, 2 sections assumes a lot of importance here, is sections 9 subsection 2, which is a deeming fiction, which tries to say that income which falls under the head salaries, if it is earned in India, please look at the highlighted portion or the portion in red. I'm not going to read everything. And for the removal of doubts, it is hereby declared that it is deemed to be earned in India if it is services are rendered in India. For those who are new chartered accountant, there has been a Gujarat High Court decision which actually led to insertion of this explanation of for removal of doubt, and service rendered in India is equal to service earned in India, because there was a different interpretation which was prevailing because of the Gujarat High Court judgment earlier. I'm not getting into it, but sometimes it is good to understand the philosophy of a particular explanation which has been added. And the Gujarat High Court Mario decision was there, which required the government to put in into the act this particular explanation. And when we really go on to the section 15, which is the charging section for taxation of salary, the I think more important or more relevant point for our discussion today is any salary due from any employer or a formal employer. I think the clause number B and C will follow clause number A. Let's not get into that. Moving further, as I said, the taxation will depend on, are you a resident, are you a non-resident, or you are a resident and not ordinarily resident. As we have already understood the difference between how to apply the conditions, but I think the finer point, and for the benefit, I have given a very specific sections here. Section 5.1 deals with resident related taxation. Section 5.2 deals with non-resident related taxation. And I think the fundamental difference being income accruing or arising outside India, I am on this particular portion, which will be not taxable in the hands of a non-resident. As far as our NOR, one of the condition is taxable under section 5.1C, only if income accrues or arises outside India from a business controlled from India or profession setup. I think this is not directly relevant to the DPS article or the salary article. So if we really look at from the perspective of the topic under discussion today, I would see 5.1C and 5.1C, which makes the income accrued or arise outside India taxable in India as a global taxation concept. There is the only difference as far as non-resident. If he's a non-resident, income accruing outside India will not be taxable. When we try to look at any taxation as far as international tax is concerned, we have to first look at the Income Tax Act. And if we find some kind of a deduction, exemption, or any beneficial provision, I think you don't have to travel to the DTAA, because I think the law is now quite settled. I am not based on section 90 subsection 2, even though it is correct to say that whichever beneficial would apply. I think a logical process here is first look at the Income Tax Act, and if you find any deduction or non-taxation under the Income Tax Act, there is no need to travel to the DTAA. So if we look at from a salary taxation, these are the two exemptions which comes to my mind first. Of course, there are few other exemptions also, which generally very specific to government employees or a consulate of a foreign country. So if we are now trying to look at a broader spectrum, these are the two exemptions which would be important. Now, what are these exemptions? One is a short stay exemption 1066, very easy to remember, 66. The first condition here is the non-resident. So what are we saying? That there is a foreign company, they send their employee to India, and now he is in India, he's working in India, and whatever salary earned by him is generally taxable, but 1066 will give you an exemption provided three conditions are satisfied. The first one is not engaged. The non-resident should not be engaged in any trade or business in India. We'll deal with this particular point. What does it really mean? Secondly, the employee stay does not exceed aggregate in 90 days. And such third condition is such remuneration is not liable to be deducted when we are calculating the net income of the foreign company or a non-resident. Now, the next one is the foreign ship related. If any person is really working, any individual being a non-resident receives any remuneration for services rendered in connection with his employment on a foreign ship, where his total stay in India does not exceed the aggregate of 90 days. So broadly, India is trying to give you a short stay exemption if you are in India for less than 90 days. I did not repeat, but even if in case of a non-resident, now we are assuming that is a non-resident, so he is not in India for 182 days or a 60 days and 365 days, then that's why he is a non-resident. So as a concept, non-resident services rendered in India, we have just seen section 912. Since he is giving services within India, his salary as a concept is taxable. And that is why these two exemptions have been given as a short stay exemption. We'll deal with this short stay exemption in one of the issues which I have already selected for discussion purpose. Now, when we are going from Income Tax Act, and as I said, first we have to find an exemption under the Income Tax Act. If we don't find it, let's then move on to some of the basic concepts of salary as per DTAA. Now, before we move there, tell me one thing, how many of you know that the term salary, which is defined under the Income Tax Act, Section 17 defines salary. Now, Section 17.1 defines what is salary, 17.2 defines what is perquisite, and so on and so forth. When we go to the double taxation avoidance agreement, based on your understanding or based on your reading, is the term salary defined under the DTAA? Can you give me some answer? Let's try to have some interactive session here, because otherwise it becomes quite a monologue. If anyone wants to unmute and then give us logic, or anyone wants to type it, it's perfectly fine. Whatever is convenient, I don't know. Is the definition of salary included in the DTAA? Any clue, any answer? No, okay. Prasanna is also saying no, Praveen is saying no. Who else? Bhakti is saying no. So in that case, what are you going to do? I'll give you an example. Let's say I have also taken one example on the allowances. So as far as the Section 17 is concerned, when any allowance is given to any employee while he is on tour, there is Section 1014 subsection 1 and 1014 subsection 2. And those two subsection gives you a deduction or exemption. So let's say you are located, your base location is in Pune, and you go out of India for some period, and employee gives you some allowance, which on return you give him the bills for those allowance. That particular allowance is really not taxable. Now, if you really look at it, is first included in the salary, and then an exemption is provided under 1014(1). So therefore, this is effectively not taxable. Now, if this is the definition and the mechanism of working out a salary as far as the Indian Income Tax Act is concerned, Section 15 or 16, 17, I'm referring to, read with Section 10. How are you really going to deal with it? Is this particular portion taxable under, let's say, if you are going to US, you are going to Germany, you are going to Japan? How are you really going to, look at it? Any clue anyone has it? Where are they going to find? Are they going to look at the definition of a salary under the US tax law or German tax law or Japan tax law? Any clue? Try to give your perception, your understanding. Let it be wrong, because we are not here, for an exam. We are here for a discussion. Since this is a virtual platform, I would have frankly preferred a physical platform. But since we are in a virtual platform, let's try to be as interactive as possible. Any clue? If there is no clue, write it as a no clue. Am I audible to everyone?
Yes, sir, you are audible.
Okay.
Yes, sir.
Yeah.
Yes, sir.
Okay, thanks. Okay, so I assume for a moment that, okay, add in total income and take credit of taxes paid. Yeah, that's Praveen, that's a next step. I'm saying, what are the components of salary? Is it a salary in the first case? Bhakti is saying definition of act will be followed where income is taxable. And where is it coming from, Bhakti? Why you are referring to the definition of act when you are trying to look at the definition or when you are looking at the provisions of the DTAA? I think two participants have raised hand. I don't know. Can they unmute themselves and speak? Organizer?
Yes, sir.
Uh,
Yeah.
Yeah, hello, Bhakti here.
Yeah.
So, I mean, as per the provisions of DTA, if the meaning is not available in the provisions of DTA, then maybe, act is followed where the person is resident
Okay.
or the income is taxable.
Okay. Parag, Pratap, I think you have also raised your hand. Would you like to give your comments? Okay, fine. So I think you are broadly right, Bhakti. So basically, those who are dealing with international tax and dealing with DTAAs, Article 3.2 of the DTAAs very specifically gives you this kind of a understanding that whenever in the DTAA itself, you will find few definitions, but those definitions are broadly uh, contracting state, resident. When you move to the FTAs definition will be there, or interest definition will be there. So what are we trying to say? That some of the distributive rules or Article 2 of the DTAA itself will give you the definitions, or the charging articles will give you the definition like what is dividend, what is interest, what is FTAs, royalty, and so on and so forth. However, uh, most of the DTAAs have not defined the term salary or remuneration. And therefore, the law says, or the logic says, whenever the convention does not define any term, then you have to go to the term which is defined under the laws of that state. So that is why we move to Income Tax Act. Just for the benefit of everyone, again, there is also a possibility that even your Income Tax Act does not define a particular term, then you go to the specific act where that definition is given. I'll give you an example. I think you being, there was a session on royalty and fees for technical services. There has been a important case law of engineering analysis by the Supreme Court. So there is a definition of a royalty, but there is no definition of a copyright. Now, for a copyright definition, the Supreme Court went on to the Indian Copyright Act, section 26, 30 of the Indian Copyright Act. They tried to decipher the meaning out of it. So the logic, what I'm just trying to say here, the article with which you are trying to look at, if that article defines, that definition will prevail. If that article does not define, go to Domestic Income Tax Act by virtue of Article 3.2. Generally, it is 3.2. By 3.2, go to the domestic tax law. If the domestic tax law also does not define, go to the other law which defines that particular term. And that is how you have to, go on a logical base to arrive at whether a particular item of income falls within the understanding of the domestic laws or not. Now, having said this, we have seen a residential status, and I think since you have already had a detailed discussion on a residential status, the most important factor which comes in the DPS is that particular resident or individual can sometime be a resident of both the contracting state, either because of his citizenship or because of his number of days. Take an example of USA. USA treats all citizens of USA as a resident of USA. And even for that matter, if you look at the DTAA between India and USA, at the beginning of the DTAA itself, in the resident section definition, they have categorically said that the citizens will be, the resident of USA. Now, take an example that a citizen of USA comes to India for work and he is in India for 200 days. Is he going to be a resident of USA or is he going to be a resident of India? We have a tiebreaker rule, and based on those tiebreaker rule, you try to resolve this, because as we saw in the earlier slides, we have to first determine is he a resident or is he a non-resident, because the scope of total income and all subsequent compliances depends on that. So we should know finally that whether he is a resident of India or is a non-resident of India, either because of the act and if he is a resident of both the countries, by a tiebreaker rule. And when we look at the tiebreaker rule, we follow this sequentially: permanent home, center of vital interest, habitual abode, nationality, and the map process actually generally comes at the end. But when you are dealing with international taxation, one piece of advice to all of you: don't assume. Every DTAA is different. If you start assuming any logic which you have gained by application of one DTAA, you start following it blindly without really looking at that DTAA, you may get a wrong result. So why I said it, because India, Japan straight away goes to the MAP procedure. MAP is mutual agreement procedure, a procedure where two competent authorities, competent authority of India will they negotiate, sit with the competent authority of Japan, and then they will finally arrive at whether a person who has come from Japan to India, whether he should be considered as a resident of Japan or will be considered as a resident of India. And once that is done, the subsequent repercussions will follow. Now, the most important article for our discussion today is generally Article 15 or 16, which is a dependent personal services. And what does that say? The article says generally, as a there are generally 3 paragraphs. I will show you a couple of agreements. So the first paragraph generally says that it is taxable in the state where the employment is exercised. So imagine a situation in case of an inbound employee, a US resident comes to India and he works within India. So he is rendering his services in India. So that is why the salary would be taxable in India as a default rule. However, the subsequent the para number 2 tries to say that it is taxable only in USA if 3 conditions are followed. These are broadly akin to the short stay exemption, which is under the Income Tax Act. We are going to deal with between the difference, but it's logically akin to the short stay exemption. What are they? So the conditions are 183 days less. We saw it was 90 days earlier. So the employer is a non-resident. He doesn't have a P in India, and this expenditure of salary, which is now we are considering as taxable or not taxable, shouldn't have been, borne by the P. So this 3 condition has to be simultaneously, fulfilled. If it is fulfilled, then even though Section 5 read with Section 15 gives India a right of taxation, because by virtue of this paragraph 2, the taxation right will flow back to only USA. Now, let us take 2 examples. This is India USA DTAA and India Germany DTAA. I'll pause here for 2 minutes and or let me explain first and then pause. So as I said, this is article number 1, the first in the India USA, which is trying to say that if the employment is exercised in India, it is taxable in India. However, even though it is taxable in India as per paragraph 1, if these 3 conditions are followed, then it is taxable in USA. Now, one more aspect: if it is relating to the international traffic on ship or aircraft, then it is taxable only in the country in which the non-resident employer of shipping business or non-resident employer of aircraft business is a resident. So these are the 3 factors which are generally applicable. Generally, I am saying few DTAAs have only these first 2. The third aspect is missing. Sometimes the employer definition is there in India Bulgaria treaty. I'm just giving you a bird's eye view so that you understand that do not assume. Open the DTAA, look at that DTAA. Similar to India USA, on the right hand side, India Germany also gives you a similar logic. First logic, it is taxable in India. Second logic, it is taxable only in USA if 3 conditions are satisfied. And the third logic is in case of aircraft and ship, it is again taxable in the country in which that ship and aircraft owner is a resident. Now, there are few words or terms which I have highlighted in red. how many of you know the difference between what is shall be taxable or may be taxed? Any one of you attending this is aware of what does it really mean? It is okay if you don't know, but I should know whether if any one of you is aware, because this is a quite one of the important point without which we cannot decide the the taxing rights. Shall is mandatory, okay. May is optional, fine. What else? Prasanna is also, Yatin Kumar is saying same. Yogesh is saying shall be taxed. Just a minute. Yogesh is trying to say shall be taxable is exclusive right, okay. And Bhakti is trying to say may gives right of taxation to both the countries. Okay. So Yogesh, can you unmute yourself? Is it possible to explain what you want to say here? Yogesh? Yogesh, I assume you are not watching movie there and that's why you don't want to unmute. Okay, Raviraj, you are saying may is discretion. Would you like to explain this? What is really meant by discretion here? Not able to unmute. Okay. Organizers, can you please help Yogesh to unmute him? Yogesh Kanamal.
Yes, sir.
Please.
Hello.
Yes, Yogesh, please go ahead.
Yeah. The shall be taxable will give exclusive right to the state, the only state.
Okay.
And maybe will give right to both the states. Means if some conditions are fulfilling, then the other country can also tax the same transaction.
Okay, so I think you made two statements. One is shall be taxable means it is taxable only in one state, and may be taxed means subject to condition it will be taxable. So what do you mean? Well, let's try to look at India USA first paragraph, which is trying to say that salaries and wages and other similar remuneration derived by a resident of a contracting state. So let's say resident of USA in respect of employment shall be taxable only in that state unless the employment is exercised in the other contracting state, means India. If the employment is so exercised, such remuneration as is derived therefrom may be taxed in India. So what you are trying to say that it is taxable in India and it will be taxable also in USA, or how does it go? Yogesh?
Yeah.
Okay. Fine. There were a couple of answers about may is or shall is mandatory, may is recommendatory. I think those are the different contexts. I think here what Yogesh is trying to say is more relevant here. So shall be taxable only and shall be taxable. Now you will see a difference here between India USA and India Germany. In India USA it is written shall be taxable only, and in India Germany it is written shall be taxable. While the second paragraph it is again similar, shall be taxable only. So the philosophy here, I think what Yogesh rightly said, is if it is shall be taxable only, then only the state of one state will have a taxing right. So let's try to interpret the second condition. Is what are we trying to say? That it is if a foreign resident, if the USA resident comes to India and renders services in India, as per the first paragraph, it is taxable in India. However, if those services are rendered in India and these three conditions A, B, C are all fulfilled, then this particular income, even though taxable under the Indian Income Tax Act provision section 5, 9, 15, it will be taxable only in USA. I think that is the philosophy with which we will discuss during our discussion purposes. And broadly, I would say all the DTAAs are broadly on similar line, but we'll deal with it in few issues which we are going to discuss. Any particular query which you are trying to resolve, please open the DTAA. No freebies here, no similar logics here. Look at the particular DTAA. Moving forward, I'm going to now start with the 15 issues which I wish to discuss with all of you. And similar to what we achieved now, I would like you to participate. Let's learn through a discussion. Now, the first one which I said, that there is a short stay exemption in the act itself. There is a short stay exemption, the second condition which we were looking at under the DTAA itself. However, if we really look at the combination, the condition one of under the Income Tax Act is that foreign enterprise is not engaged in any trade or business, the 90 days concept, and the remuneration is not liable. While on the right hand side, I have taken an India-Germany example for our discussion purpose. The right hand side is trying to say that remuneration is paid by on behalf of a non-resident. Secondly, it's a 183 days. And thirdly is the remuneration is not borne. Now there is a condition number 3 on left hand side, it's not liable to be deducted, and condition number 3 of India Germany is not borne. I have a very specific issue for discussion, but for the purpose of this slide, let's understand that it is not deductible for the profits which we are trying to compute. As far as condition number 2, it is 90 days here. On the right hand side, it is 183 days. Condition number 1 is very peculiar. As far as section 10 is concerned, it says that enterprise is not engaged in any trade or business. Now imagine a situation that German foreign company is sending someone to India and he is rendering his services in India. Generally, I would say that when any employee is coming on behalf of the employer, definitely employer is going to carry on some business in India. He will either receive a P income or FTS income or any other income for that matter. So condition number 1, as far as the India-Germany treaty is concerned, the condition is only that the payment is by a non-resident. If we really look at, if they are not strictly comparable to each other, can anyone give me and their understanding that when would you likely to get section 10 exemption, 10.6.6, the left hand side exemption, anything which strikes you where section 10.6 exemption itself will be available and you don't have to travel to section or to article 15. Anyone? Any guess? Anybody wants to try? Okay, let me try to give you some support here. So the condition number 1, as far as section 10 is concerned, okay, for philanthropic activity employee in India, very good example. If employee is sent on secondment deputation, no Bhakti, when employee is sent on deputation or a secondment, the first problem always comes at who is the real employer. I'm not getting into that. But secondly, when that person is really doing some services in India, and if those services are actually taxable in the hands of the foreign enterprise, then the foreign enterprise will be deemed to be, carrying on business in India. So I think I would broadly say the example which you have given may not fit into condition number 1, but Prasanna Prakash has given a good example, philanthropic activity. I'll give you a couple of more. So one of the possibilities, a foreign enterprise has a liaison office in India. Now, liaison office by nature is a preparatory and auxiliary activity. They are not supposed to conduct the business. And once they are not supposed to conduct the business, if someone is working at the license office and for less than 90 days, there is a good possibility that you may be able to claim that exemption under 10(6) itself. Second possibility is a Morgan Stanley kind of a judgment where employees were sent for stewardship activity in India. And when the stewardship activities were done, they were only trying to ensure that the quality of work which is performed by an Indian company is as per the global standards. So in that case, the income was not taxable in the hands of the foreign company. And so because foreign company was not engaged in any business. So I think philanthropic purpose is a good example. License office could be one. And as I said, stewardship activity could be one example. So try to understand that the spectrum with which 10(6) applies and the logic with which Article 15 applies are, I look at it completely differently. Even though the condition seems to be more or less similar, but they operate in a completely different environment. Article 15 exemption is generally, I have seen in a practical scenario where, as I said, if someone is coming to India for delivering some services, if there is no PE, because generally PE can, I am just saying, assuming PE rule says that it is 180 days has to be done, the service or installation services has to be done. So if the non-resident employee deputes their employees to do installation activity in India, in that particular scenario, that particular income may not be liable to be taxed as a business income in the hands of the permanent establishment of a foreign national, foreign enterprise. And therefore, those employees which are earning salary in India may get a short stay exemption. So let's say they are here for 120 days, 150 days. Two employees comes for installation activity. Because the payment is done by a non-resident, condition number 1 will be satisfied. They are here for less than 183 days, satisfied. And since the non-resident doesn't have a PE, there is no question of a PE, bearing that expenditure. So there is a likelihood that those employee can claim a non-taxability under Article 15. Under Section 10 would be difficult because, as I said, PE is carrying on business in India and it is more than 90 days, the example which I have taken. So this is the issue with the short stay exemption. So you'll have to look at the facts of the case, look at the relevant DTAA and try to apply your rule. I'm now moving to the issue number 2. We saw the exemption for ships also, 10(6)(8). Again, on a, if I try to look at a comparative 10(6)(8), and I have also shown you an article, the third condition which deals under the dependent personal services article. So 10(6)(8) talks about you will get an exemption if it is received or due to any such individual being a non-resident, the remuneration for services rendered in connection with his employment on a foreign ship, and whether his total stay does not exceed 90 days. So these are the 4 conditions. If those satisfied, you will get a straight away exemption under the Act itself. When you go to the DTAA, and I'm taking Germany as an example here, unlike 10(6), which considers only shipping, the DPS article also considers aircraft. That's I think one of the most important difference with which we are trying to deal with it. Secondly, the Section 10 deals with 90 days concept. Now you will see no 90 days, 183 days concept as far as those who are working on a ship or an aircraft. The concept being here is it is taxable in the contracting state of which the enterprise operating that ship or aircraft is a resident. So a different philosophy, different approach follows. Firstly, for those who are working on ship or aircraft, and again 10(6)(8) vis-a-vis Article 15 is completely different than one another. So straight away, no one-to-one correlation. So you will have to really deal with what is possible first, but always look at 10(6)(8). If it is exempt, no need to go to Article 15. if it is taxable under section 10 or not exempt under section 10, move to article 15 to see whether it is not taxable. Am I going too fast? I assume no for a moment. Try to give the answer to this particular query. I'll give you some time. Let us read out the facts. So Mr. A is a citizen and resident of country, whichever country you think of. He is employed with foreign company, tax resident of that same country. Now, foreign company deputed Mr. A for work in India on 1st January. It can be 2022, 2023, whatever it is. He was working under the supervision of FCO. So this is not a concept of deputation or a secondment to Indian employer. So a foreign company deputes foreign employee to work in India. Now he continued to work in India till 10th of July of the same calendar year. Let's then, for the purpose of our understanding, take 2022. That he comes to India on 1st January 22. He goes back on 10th July 2022. Assume that foreign company does not have a PE or a business in India based on the language of the relevant ETAA. Whether remuneration payable to Mr. A for work performed in India shall be liable to be taxed under the head salary. Any views here? Do you want me to go back to the maybe this slide, which may help you? Try to give the answer. I hope you understood the question. I am assuming it. So do you want me to be on the slide of the question, or you want me to be on this slide for reference purpose? Which one would you prefer? $14. Okay. 14 I am. Okay. Rajesh is trying to say exempt from first financial year, taxable in second financial year. Okay. Any other? Not liable, 90 days limit. Okay. Good. But okay. So 1st January to 31st of December, 31st of March, it is less than 90 days. And that is why possibly you are trying to say it is a 90 days and we are saying he doesn't have a PE, so he's not engaged in trade or business in India. I only said he doesn't have a PE, but there may be some income for which he is there. But I think I take your point for a moment, that you are trying to use 90 days in such previous year. Any other answer? Not liable, 90 days, no PE. Okay, fair point. I understood, Gopal Krishnan. What about if there is some kind of a doubt as far as the condition number 1 of section 10, would it fit into article 15? Assume that article 15 is India, Germany, and that person is coming from Germany. Would that fit in that exemption? Guys, you'll have to be a little faster. I have to take 15 issues and we are on just the 3rd issue. Yes. Okay. Rajesh feels exemption under article 15 is available. Anybody else? Prasanna is saying yes. Chetan, yes. Rohit, yes. Good. So I think we are getting the pulse of that question. Great. But if I modify this a bit, if he comes to India on 1st of December and departs on 10th of July, what would be the answer? Rajesh is saying DTAA or income tax, whichever is beneficial, is yes, Rajesh. But this is a very philosophical kind of a statement. Whenever you are making this statement, first try to look at whether it is taxable under Income Tax Act. If it is exempt under Income Tax Act, you don't have to move to the DTAA at all. If it is taxable under Income Tax Act, then move to the DTAA and then say whether DTAA comes to your rescue, and then whatever you said was right. Priyanka Bafna is saying taxable under Income Tax Act or taxable under DTAA also. Priyanka. Chetan says not taxable. Gopal Krishnan says still no P. Okay. Taxable Income Tax Act. Okay. What about fair point? I think taxable under Income Tax Act is what I agree. What about the DTAA? Any clue? Once it is taxable under Income Tax Act, you have to move to DTAA to check it. Taxable as more than 183 days in calendar year. Okay. Which calendar year? Do you have a different calendar year? If calendar year means 1st of January to 31st of December, if this person is there from 1st of January to 10th of July, whether 183 days threshold crossed or no? Taxable under both Act and DTAA, Bhakti. Okay. Rohit is saying not taxable under DTAA, 183 days in fiscal year not exceeded. I think this is what I precisely wanted to show you, Rohit. When you are reading a DTAA, read DTAA, don't put your any particular words. You are trying to say he exceeded 183 days in a fiscal year. So fiscal year means April to March. Calendar year means January to December. Are you using Jan to December? You are using April to March. April to March. So if it is April to March, 183 days are not over. And that's the precise point. What I'm trying to show it to you, that if taxability fails under the Income Tax Act, you are moving to in DTAA. Yes, PG Gopal Krishnan, you are right. 2 different years of Indian Income Tax Act, correct? That's the point which I'm trying to stress upon. So this is 183 in fiscal year. Having said this, and now that you have understood the point which I'm trying to give here, let me give you one more perspective also, that not all treaties has this 183 days same concept. Okay. So India-UK treaty talks about 183 days in the relevant taxable year. India-USA talks about 183 days in the relevant fiscal year. India-Australia treaty says physical presence for a period not exceeding 183 days in any 12-month period commencing or ending in that fiscal year concerned. Now look at the treaty and the different languages. In one treaty, you may get that treaty benefit, but if it is a Malaysia or Australia treaty, you will lose that exemption. I think the moral of the story, again, what I'm trying to tell you is, please do not assume. We are trying to look at or understand the DTAA on a concept note, not as for specific DTAAs. So whenever you encounter this question, don't assume, simply open the relevant DTAA and look at the specific language within that DTAA. Had this been Australia, your answer would have been different. Secondly, if you are answering one question today and a similar treaty again comes for your analysis next year, please again open it. And why I'm saying that? For example, let me give you that example also. In India-Poland treaty, the original condition was the recipient, as far as that 183 days in the previous year, India-Poland treaty got amended, and the new protocol which stated that period not exceeding aggregate 183 days any 12 months. So why I'm saying and why I'm again and again, coming to the same point here is apply the DTAA specific, and please open the DTAA on the date when you want to invoke it. Don't just be overconfident about your analysis which you did 1 or 2 years or 3 years back. It may not survive. Every time now and then there is some or the other thing which is happening. Very recently, India-Singapore DTAA got amended. India-Cyprus treaty was amended. India-China treaty was amended. I'm not too sure whether all of you understand the multilateral instrument impact, but significant number of treaties have been amended. So again, the takeaway for us is the short stay exemption is not similar to Income Tax Act. It is different, but within the treaty also it is different if you compare different treaties. Have you understood the point which I wanted to drive to all of you? I am now moving on to the next and the little complex topic now. I think the complexities will keep on increasing the moment I go to the subsequent slides. It is already 6. I am only on the issue 4 and I have to complete all the 15 for the benefit of you. So I'll be little faster, but whenever you feel I need to explain it little more, please feel free to stop me. Okay, write on in a chat box. So now the next technical point is hypotax, tax equalization. These are the buzzwords, the tax words with which the cross-border employment taxation is filled with. Now, hypotax, if we try to first understand the meaning, consider a situation that you are coming from a country where the income tax rate is 15%. I'm on an income tax rate means the income tax on employment. Okay, I'm not on the income tax applicable to the companies or LLPs. Since we are discussing a topic of individual taxation of salaries, I'm giving you an example that look at the taxation, the rate of taxation in the host country, or sorry, in the home country where the person is a resident. The taxation rate is less than, let's say, 20% or 30%, as the case may be. Take a simple example of UAE. UAE doesn't tax its, individual earning salaries, or Singapore taxes at 17%. Few other countries have a lesser income tax on individuals. Now, if that country or if the employer of that country wish to send that employee on a deputation or for work in India, very simple, that employee would be ready to work in India, but definitely he will not bear that additional tax. We can take a simple example. If 1,000 is the salary in UAE and he is paying no tax, I think this example is not very good. Let's take an example of Singapore. So if the employee belongs to Singapore and he is paying 15% tax at Singapore, so his net home salary is 85. When he comes to India, and unfortunately, consider a situation that he becomes a resident in India, what will happen that India will tax this at 30%, and he will pay 30 rupees as a tax in India. His net salary will be 30. Assume for a moment there is a global taxation also applies at a home country, which is Singapore. Singapore will also tax it 100, 15 rupees tax. They will give a credit of Indian taxes 15 out of 30, which is the total tax paid in India. But net, that poor fellow has suffered extra tax in India, and the total tax amount will be 30, even after FTC, if at all. So the concept how it works is, most of the time, whenever there is an employer who is deputed for a work at a foreign jurisdiction, the home jurisdiction employer ensures that he is not worse off. So he will continue to get 85 minimum. Just because of the tax, this will not get reduced. And this applies for outbound employees as well as inbound employees. So what happens is, at a step 1, what the employer does, his salary is reduced for a calculation purpose by 15 rupees, which is a tax in Singapore. So his salary is 85 now. When he comes to India, I'm just assuming that 85 remains 85 in India. What happens here? The employer then considers entire tax liability in India as to be borne by the employer. So in India, let's assume that on this 85, the grossed up tax is approximately 30%. So this 25 will be paid by the employer. Now, if we really look at what is really happening, the employee, when he was at Singapore, was getting 100, paying tax of 15, net take home salary is 85. In India, when he comes to India, his salary, as I said, as a step 1, reduced by 15, so he is 85, and tax is borne by the employer. So net again he gets 85. So this concept is called as a tax equalization or the hypo tax. Now what happens, because there is a possibility that this 15 rupees which was deducted there can also be considered as a income, because his income still remains 100, but for this all taxation purpose, it is tentatively or temporarily reduced by 15. So what is the judiciary here? There is no concept of a hypo tax or a tax equalization under the Income Tax Act, but fortunately we have a judicial analysis here which tries to say that the hypo tax which is reduced in the home country will not be considered as a salary, step 1. So 15 rupees is out, his salary is 85. On this 85, we are now going to gross it up. Section 195A will apply. And the 25 rupees tax, which is now India is paying, or the employer is paying in India, will be first added to his salary, which is 110. But the tax on that, because this is a perquisite, so whatever is paid on behalf of the employee becomes a perquisite. But the tax on the perquisite will be a non-monetary perquisite. Let me explain you with the help of an example so that you understand what I'm trying to say. So in this particular case, if it is not a case of section 1010 CC, you have a 1000 salary, you gross it up to 300, the employer pays tax of 300, that 300 again is grossed up. So there is a multiple grossing up which really takes place if it is a multiple grossing up. However, the second column is more important for our discussion. In case of a hypo tax, what happens here is this 1000 is equal to 85. What the point which I was trying to explain. So 1000 will be first added with 300 rupees, which is the first level tax. On that 300 rupees, there will be a 90 rupees tax again, and it stops at this. This 90 gets an exemption under 1010CC because the way it works, it is a multiple gross up or it is a single time gross up. And with this, because of the exemption of 1010CC, there is a tax overall 300 in India jurisdiction as against a multiple grossing up, which this is the answer. So the tax hypothecation works in a way that Indian income tax department gets their due taxes. However, the foreign employee does not suffer any extra tax. If 85 what he was getting in that country, he continues to get 85. The grossing up impact is stopped at one stage itself, and ultimately the entire outcome of this particular complex discussion remains 85 to 85. As I said, this particular concept is not coming out of the Income Tax Act very clearly. However, we have a few judgments. I have included number of judgments for our discussion purpose. I will only read the relevant portions. this presentation will be shared to all of you. You can then, refer to different judgments which you have cited. So this particular judgment, SEDCO Uttarakhand High Court has categorically said that the tax which is paid at first level will be perquisite, but the tax on perquisite will not be considered as a monetary perquisite. It will be considered as a non-monetary perquisite, which will enjoy 1010CC exemption. So ultimately, the impact which we want to have as far as the tax equalization is concerned will be achieved. The discussion on 1010CC is also with respect to domestic taxation. So I'm not getting into this in detail, but whether all of you have understood what I wanted to share with you as a broad concept of tax equalization, reduction of salary at first instance, and then payment of that salary in India by the employer, but ultimately you get a similar kind of a, I would say, an equation. Priyanka is saying, yes, I am relieved because this is one of the topic which is generally very difficult to comprehend. But thanks, Priyanka, you have increased my morale. Thank you very much. Anyone else? Anyone has still a doubt on what I just said? PG has also understood. Thanks, PG. There is one more Delhi High Court case, Yoshio Kubo, which is on a very similar line, which tries to give you a logic as to the tax paid will be perquisite, but the tax on the tax will not be a perquisite, or it will be a non-monetary perquisite eligible for 1010C. Now let me go to the next, again a complex point. If we have understood, let me see, what happens if the home country has higher taxes? That's what I said, Priyanka. So the point here is the employer and the employee needs to really look at, are you worse off by going to the, let's say in our case, India? If you are not worse off by going to India, generally tax equalization concept is not utilized itself. So a reverse way, let's say if the US person comes to India and US has a 35% tax rate. So if he has a 35% tax rate in his home country and he comes to India on a temporary basis, he pays tax equal to 30%. So what will happen? He will get a foreign tax credit in his home country, and ultimately 35 will remain 35. So in that case, equalization concept is generally not used. Equalization concept is used whenever a low tax jurisdiction person comes to country like India, where the maximum marginal rate can go up to 42%. So I think that is the logic with which this equalization is used. Understood? Let me assume understood. Please post your question. Let me move to the next topic, which is one more difficult topic to comprehend. So the point here, what I'm trying to explain, what we have understood so far is whatever is received in India is always taxable. Whatever accrues in India is always taxable. Now consider a situation, and that's why I have given a table below, that if it is a resident, whether it accrues in India, whether it receives in India, whether it accrues outside India, global income is taxable. Section 5 will step in. At the most, for an outbound employee, but still a resident of India, he will get a FTC. As far as the non-resident, if income arises outside India, it is not taxable. I am on this portion. Now consider a situation, and I actually trying to deal with you with an actual case. A TCS employee working with TCS India was deputed to UK for an assignment, and assume for a moment for 6 months he went to UK. Now because of the way the days work, What I'm trying to give you, because in India, now you know already residential status, there are two main conditions. One could be 182 days condition, or second could be 60 days condition. Either or the cases, if he still remains a resident, the first logic will prevail. The resident, everything is taxable. But if he becomes a non-resident, because once he goes out for an employment, the 60 days concept goes to 182 days concept. So the two conditions will be at par as far as the year of when he goes outside. 182 days he has to be within India. And if that employee leaves on, let's say, 1st of July 2022, so in that particular year, he will be only there for 90 days. And since he's going out for employment, I'm just saying out for employment, and we have a non-residential status. So if the employee, TCS employee, goes out of India, he achieves a non-resident status, but the salary is credited to his Indian account. Now, the moment the salary is credited to Indian account, the first line says received or deemed to be received in India, which is for even a non-resident, it will be taxable. So are we now trying to say that a person, in this case, an employee of TCS, goes to UK, performs services in UK, he is a non-resident Indian for Indian Income Tax Act purpose, but just because the salary is credited to India account, the salary will be taxable. And now understand, the moment he is a non-resident, if India taxes this salary, a foreign tax credit will have to be given by UK, but UK will not accept this concept. So that particular employee is in a big mess. What is the opinion of the participants here? If a non-resident employee goes abroad, he becomes a non-resident, but the salary is received in Indian account, will that salary will be taxable in India? What is your view? Don't worry, in any ways, I'm going to give you all the answers, but feel free to give your views. No. Rajesh Kamath says no. Prerna says GTAA. Jayesh is saying not taxable in India. I would request you to give me a logic. Is it not taxable because of the treaty, or it is not taxable because of the Income Tax Act? Prasanna is saying it is taxable because it is received in India. Okay. Prerna is saying not taxable due to DTAA. Okay. Shekhar is saying taxable in India, but non-resident must go to check DTAA for any benefit. Okay. Not present in India, so not taxable in India. Jayesh is saying deeming of deeming. Okay. Okay. Let me explain. First, understand why this is so important and why I asked you whether under Income Tax Act or otherwise. I think Sagar is saying accrues outside India. Great, great. I think let me try to answer this particular question. That Acha, I think one person was bang on. Let me illegal like 56 too. PG Gopal Krishnan. Let's not get into legality here. Let's restrict ourselves to taxation here. Yogesh but saying not taxable because salary not exercised in India. Okay, so he means not taxable because employment is not exercised in India. I think credit goes to Yogesh. But now let me explain for the benefit of everyone. So what are we trying to say? When a non-resident is going to a foreign country, Section 5 talks about taxation if it is received in India. The point here, what we have to understand, that receipt of what? Income, not money. So there has to be an income first. And now, since we are talking about salary, you have to now look at Section 15. So you have to read Section 5 with Section 9.2 with Section 15. I'm only still on the Income Tax Act. I'm not traveling to the DTAA. I'll come to DTAA a little later. But the point which I'm trying to drive here is the act should not be read. Section 5 should not be read as just because you have received that money in India, it is taxable. That is not the scope of 5(1)(a). The scope of 5(1)(a) will only be triggered when there is an income which is taxable in India and received in India. Because otherwise the 5(1)(c) becomes OTOs and we'll have to give meaning to all 5(1)(a), 5(1)(b), 5(1)(c). So what are we trying to say? Similarly, 5(2)(a) and 5(2)(b). Okay. So in this case, what happens? If the person is a non-resident, section 5(2)(a) and 5(2)(b) will get triggered. Even though it is received in India, it is earned outside India. The moment it is earned outside India, it is not liable to be taxed under section 5, read with 912, read with section 15. So at the Income Tax Act threshold itself, this amount is not taxable. If you go to the judicial decisions which I have cited here, 20 years back, it was more of a concept that it is not taxable because of the DTAA. But in the last 10 years, we have enough judicial precedents which says that it is not taxable at section 5 itself. And why I'm saying section 5 exemption or section 5 non-taxation is even more important, because the moment it is not taxable at 5 itself. So we are now talking about a non-resident earning income outside India, not taxable under section 5. The moment you say this, he doesn't need a PAN. He doesn't need a TRC to claim the tax benefit under the DTAA. He doesn't need to have to file a return also. There is a difference between you getting a benefit under a DTAA and you are getting a benefit under the act itself. I would always try to look at the act first, because the moment something is not taxable under the Income Tax Act, you are far better off as compared to you are getting a non-taxation kind of a concept under the DTAA. Because please do not forget, for a DTAA concept, you need to have a TRC, and as per interpretation, it's not a foolproof, but it's my view. The moment something is taxable under the Income Tax Act, but not taxable because of the DTAA, you still have to file a return. First, for filing a return, you still need to have a PAN. Second, and the third and the most important, to avail the DTAA, you need to have a TRC of the foreign country. So look at the compliance and the conditions. You may satisfy the Article 15 of India, Germany, India, USA, or whatever country, but there are some compliance related points attached to it. So the point which I was trying to clarify is, please first look at whether it is taxable in India or not. And when I'm saying this, there is one more aspect which also I think all of you should know. There is an exemption method. Very frankly, other than India, Bulgaria, I have not found exemption method. Okay, but for a moment, if TCS employees goes to Bulgaria, or whichever, the inbound or the outbound, Bulgaria DTAA goes with an exemption, so that income is exempt under the exemption method, not necessarily under 15. But again, here, what are we trying to say? It is not taxable under the DTAA exemption method. My point was, is it taxable under the Income Tax Act itself? If it is not taxable under the Income Tax Act, you don't have to travel to DTAA, don't have to look at Article 50, don't have to look at Article 24 or 25 of the respective DTAA. So look at the queries, look at the philosophy with which you can really, avail this particular exemption. Going further, only on, I'm still on this point. British Gas India was the first case where, it really paved the way for particularly non-taxation. But I think in this particular case, my understanding is this case gave the exemption more on Article 15 which a non-resident exercising employment outside India, and that is why it is taxable only in the foreign country, and that is why it is not taxable in India. However, I'll go to one more case, Utanka Rao. It's a Calcutta High Court case, which has now very categorically said that this income is not taxable under 51C. So be it resident or not resident, if the employment is exercised outside India, then it is accrued outside India, and therefore it is not taxable in India, especially in the non-resident case. And for this Calcutta High Court judgment, they have referred to even a Bombay High Court judgment and a Karnataka High Court judgment. So we have 3 High Court judgments now. Salary is earned where the employment is exercised, and depending upon the residential status, and especially if he is non-resident, there is no need to go to the DTAA. It will be non-taxable under the Act itself. I think there are some chat box. Rohit is saying the non-taxability will still hold good. Will still hold if the employee is paid by TCS in India and is on a deputation to TCS foreign only under a knowledge sharing project. Can we still say employment exercise outside India? What is a knowledge sharing project? I don't know. But the point which I'm just trying to drive here is, if whatever his duties which he was doing in India, now he is supposed to do outside India, he is working outside India. So he is performing his duties outside India. Therefore, his employment is exercised outside India. And therefore, once he becomes a non-resident, for the services which he is performing outside India, it will not be taxable in India. I think I've made my point clear. As far as Section 5 only, for a non-resident, you get a special treatment under the interpretation, thanks to various high courts. Manoj is saying Philippines doesn't issue TRC. We'll discuss about TRC. That is my point number 15. We'll discuss, Manoj, please remind me of this particular point again. That is my point number, issue number 15. So there is one more case. Why I'm trying to give you this, different cases for your understanding. But this is a case I'll discuss with you only for information purposes. Because this is completely different interpretation, different logic. Consider, and let me try to explain rather than reading what is written. Consider that a person is, leaving India, he goes to USA, and while he is in USA, he pays USA federal tax and USA state tax. So assume for a moment, he has a salary of 1 lakh, I'm just assuming, and he pays 25,000 federal tax and 5,000 US state tax. So his net salary is 70,000. Now, if this person is a resident of India, we are saying that for a resident, whether he receives or earns or accrues income outside India, receives in India, everything is taxable, global taxation basis. However, what is the amount which he is supposed to, club in India? Generally, whatever I have understood, it is 1 lakh will be considered as a taxable in India, and the foreign tax credit of federal tax 25,000 and state tax of 5,000 will be given in India, not the 70,000 rupees, which is the net salary which is considered in India. So for the purpose of aggregation, it is 1 lakh aggregated, not 70,000. So this is a ITIT Bangalore case, which says by interpreting section 51A, 51B, in contradiction to section 51C, what they are trying to say that what is the income which he has earned in India is 1 lakh. However, he has spent 30,000 as a tax outside India, and that is why his income itself is 70,000. So you please club only 70,000 in India. This is completely a different logic. I have not followed this, but for the benefit of everyone, I have included this in a presentation. It doesn't stop there. What is trying to say ITIT Bangalore, that once you include 70,000 in India, you will still be given a credit as per the DTAA between India and USA Article 25. And for that 25, maybe for the purpose of calculation, you can still consider 1 lakh. I think this particular case, I personally don't follow it properly. Is it a reasonable view or is it an aggressive view? I leave it to you. But the point which I'm trying to give you is, when you come out with an innovative mind, innovative logic, possibly you will come out with a completely different logic. Just a corollary, since we are not discussing on business income, but for a business income, section 48(2) explanation 1 says that, take an example that there is an Indian company has a P in outside India or P in USA, let's take it that way, and they pay same 1 lakh is their income from business, and they pay 25,000 state tax, federal tax, and 5,000 state tax. So their net income is 70,000. As far as the income under business concept is concerned, it is always considered as 1 lakh. However, to the extent you are not allowed a foreign tax credit, you are allowed a tax deduction. Now, in case of a business, what I'm trying to tell you, whatever foreign tax credit you are not allowed, you can claim it as a business deduction. But this is only for a business. We are not discussing business, but I just wanted to give you a heads up as to, there could be a different ideology with which things can work. I don't follow this case, but possibility, if someone wants to follow, go to the depth of this case and try to look at. Priyanka is asking, considering you are getting a tax credit, it makes sense to consider 100. Yes, Priyanka, but if you really look at this particular case, he is including only 70 and also taking a benefit of the DTAA FTC. I don't know how does that really work. It is a double dip and I don't completely follow the logic. But for the benefit, I just thought of, introducing all of you some, innovative kind of a judgment which can also come to you while you are discussing. Similarly, Texas Instrument Authority of Advance Ruling, very recent kind of a judgment. Again, this particular judgment has also categorically said, in case you are earning income outside India, it is not taxable in India as far as Income Tax Act is concerned. I think I'll leave this point at this itself, but the point here is, please understand whether you are getting a non-taxation under the Income Tax Act or the DTAA, and the procedural formalities, the impact could be little different. Maybe even though you are getting a non-taxation concept. Let me now move to issue number 7. We discussed about income which you have received outside India. Now let's take an example of allowances. Let me continue with the same example. So Indian employee going abroad, he still is a resident. Okay, I am now not talking about a non-resident. He's still a resident. So he goes abroad for 6 months. Let's say he continues to be an Indian resident, but he gets a living allowance. Let's say he gets a 2 lakhs per month living allowance for staying in USA or UK, for staying, lodging, boarding, anything and everything. So when he is employed with TCS India and he goes on a project for work outside India, and he is paid allowance, fixed allowance, against which he is supposed to spend abroad, the logic again stands here. There was a conflict whether this was taxable or not, but now we have a categorical explanation coming from a judiciary that when your employment is with TCS India and you are going outside India to US or UK for work, So you are on a tour. And when you are on a tour, section 1014(1) kicks in, rule 2 BB of income tax rules kicks in, and to the extent you spend that amount, you will be granted an exemption. If we have understood this, there is a one more point which I just wanted to highlight. There was a Supreme Court case in L&T earlier, which tried to say that there is no obligation for an employment to verify the bills because there was no mandate under the Income Tax Act or CBDT has not specified. This case has a significant impact. So consider a situation where you are disbursing salary, you are a CFO or a responsible person at TCS. Are you supposed to ask for the bills for this 2 lakhs per month for 6 months, 12 lakhs? Are you supposed to ask for the bills? Whether the employee is supposed to give the bills back to employer so that employer then can give you a deduction, or only the net amount will be taxable? My personal view is Supreme Court judgment in Larsen and Toubro seems to have been now overridden, because now if you look at the CBDT yearly TDS circular, it specifically mentions that for all such allowances, the employee will be under an obligation to give the proofs to employer, and then employer can consider 1014 allowances to the extent expended and give an appropriate deduction for salary. I am not following a view that you don't require a proof. So for those who are handling employee related taxation cases, or for those who are handling, let's say, TDS at company level related cases, my sincere request to you, please read the judgment of Larsen and Toubro in detail. Please read yearly CBDT circular, which is issued for 192 TDS. I feel no longer there is a possibility that you will be able to claim the deduction without the proofs. Proofs is a must. Otherwise, employer should deny the expenditure or without a proof and should tax this entire 12 lakhs. I'm just saying, if you don't give expenditure worth 12 lakhs. If you give expenditure worth 6 lakhs, he will tax 6 lakhs and balance 6 lakhs will be exempt. So this is the concept of a tour, and you have this case law which supports whatever I just said, that what is the logic of 224 3A 3B, what is the logic of 1024 1, 1024 2, what is the logic of rule 2 BB1 and 2 BB2. I think I'm not getting into this technicalities, but suffice to say, please be careful when you are on a tour. When you are on a tour, the meaning of the tour has been explained quite in detail in this particular case law, which will be helpful to all of you. Let me go to issue number 8. I think I need to speed it up a bit. We are already at 6:40. How do you want participants? Should I speed it up, or we stop at 7:05, 7:10 to the extent wherever we have reached? Or how do you want me to now move ahead? Is the speed okay? You want to still go ahead with the same speed, or you want all 15 issues to be covered? Okay, same speed, speed up. Okay, there is a confusing guidance. Okay, let me just someone is saying extend, no problem. Those who wants to see IPL matches, I think they will miss. I don't know. But I think majority wants to go with the same speed. Okay, let's try to little bit. I'll increase the speed, but we'll ensure that you understand the point. I think taxation of ESOP is a very fundamental aspect here. What is ESOP? ESOP is generally what we have understood is the employer grants the ESOP, there is a vesting period, then the employee exercise that, he is allotted the share. So there is a taxation at the time of allotment, and there is a taxation at the time of sale. Taxation at the time of allotment is on the basis of fair market value on the date of exercise. Please understand what I'm trying to say. Taxation is always on the time of allotment. Taxation is not at the time of exercise. So if you have exercised the shares in March, but the shares are allotted in April, this is a bad planning. Please execute this ESOP well. Try to have this exercise and ESOP allotment in the same year to avoid multiple subsequent problems. But suffice to say, the stage of ESOPs works in this fashion, and we have a very categorical finding, including section is categorical that it is at the time of allotment, it will be taxable. But now we are discussing cross-border employment. So imagine a situation where employee of US is granted ESOP, and that vesting period is 2 years. And out of that vesting period, 1 year he works in USA, and 1 year he is actually working in India on a deputation. Now, how are you going to tax it? Or rather, do you have a right of taxation? Because ESOP is granted when he was a non-resident, when he was working with USA, in USA, but now for a partial period, he is working at India. This partial period can be 1.5 years, 6 months, 1 year, or you can take any combination. The point which I'm trying to drive is, and this can also happen the other way around. If the TCS employee has a ESOP, but he becomes a non-resident, and the ESOP is granted when he is a non-resident. So the point here is how the ESOP is taxed. As a theory, it is taxed at the time of allotment on the basis of fair market value on exercise date. But the cross-border situation creates some hurdles. So for this, we have some guidance from ITIT Delhi. They are trying to give a good concept as to this has to be proportionately taxed. So in my example, if the employment exercised 1 year during the vesting period in USA, 1 year he was here in India. So you whatever is the benefit which you want to tax it, you make it a 50. First compute the total benefit. Out of that, 50% will be taxable in India and 50% will be taxable in his home country. This is a guidance which is given under this ITT judgment. Now the real point is, this is our judgment and we tax it on the date of allotment. But for your understanding, I am giving you few countries which are trying to tax it at a different time. Consider a situation of France. France is taxing at the time of grant. Hungary is taxing at the time of sale. Now consider a situation that an employee who is employed with a France employer, on day 1 of the grant, he is in France. There is no connection with India. Entire ESOP is taxed in France in day 1. Now he comes to India, and during when he was in India, the grant is exercised or the ESOP is exercised and allotted. Look at the problems with which you are now discussing. The taxation has already taken place at France at the time of grant. However, since the employment is also done in India, India will also get a taxation right because of the proportionate method. Unfortunately, in the country of residence, which is France, taxation is year 1 and India year 2 or year 3. You can now imagine a situation how this poor fellow will really get a foreign tax credit. But I think I don't have answers to many questions. But as far as India taxation is concerned, unfortunately, it will be taxed. India should tax it proportionately, deduct salary, include it in the Form 16 and hand it over to that resident. There is a good guidance coming from OECD also. The only point, possibly, I think we are short of time, but there is an American option and European option. Sometimes the ESOP is connected with the subsequent employment and sometimes it is not connected with subsequent employment. So what I'm trying to give you or explain you, on the date of grant itself, the right has accrued. Possibly you are allowed to exercise after 2 years, but there is no condition that you should continue in employment. So for an example, if the French person or US person, in the year of grant, he is a resident of USA, there is no condition whatsoever that he should continue with that employment, and he switches that employment with a different USA person. And with the second employer, he is in India now, whether the first employer ESOP will be taxed in India is a difficult question to answer, because as I said, there are two different concepts. India doesn't recognize two different concepts. India simply recognizes a concept that the moment the grant, the ESOP is allotted, it is taxable. Whether European, whether American, it is not necessary for Indian taxation. So please be careful whenever this kind of a situation arises. Please look at the case law. Please look at the OECD. Please look at the taxation of the host country or the home country, and then try to look at what is the value which should be taxable in India, and then accordingly include into the Indian tax return or Form 16, as the case may be. This is what I wanted to give you on ESOP. I am moving on to issue number 9, which is taxation of Social Security. This is one more, interesting point here. What is Social Security? Is a PF, ESI kind of a, or pension kind of a thing which comes to our mind. But what happens, generally, that when a USA employee comes to India or an Indian employee goes to USA, there is a concept of a social security agreement. What is those social security agreements? There are number of countries with which India has entered into social security agreement. I have given you the name of the countries. 18 countries we have a social security agreement. This is in addition to the DTSS. Okay, so we are not on DTSS for a moment. We are on social security agreements. So in case of a social security agreement, what are we trying to say? That once that employee comes to India, he need not pay Indian PF. In a similar case, if an Indian employee goes to USA, he need not pay US social security agreement, social security benefits, because there is a concept of international worker definition, and based on that, the double payment is avoided. So if you have a country with which India has a social security agreement, wherein India allows to continue USA, example I'm giving you, USA is not in this 18, could be a wrong example. Let's say Germany is a good example. So if German employer deputes his employee to India, this employee need not pay Indian PF. He can continue to pay German PF because of this social security agreement. Similarly, if Indian employee goes to Netherlands, he can continue to pay only Indian social security. He doesn't have to pay Netherlands security. This is called as international worker. But now understand there are only 18 of these. And I am trying to give you an example. He goes to USA. So what happens? Once he goes to USA, he will continue to pay Indian taxes, Indian PF also, or Indian social security, and he continues to pay foreign social security also. Unfortunately, what happens in that particular case, I'm taking you an example. Say a German employer deputes German employee in India, and when he is deputed to India, assume for a moment that he is an international worker. India has a social security agreement with Germany, and therefore when he is working in India with Indian employer reimburses the salary which is paid by a foreign employer in Germany. So when this salary is being paid, the entire charge which has come from German company to Indian company is being paid off, which also has an element of employee contribution to German social security, which also has a employer contribution to social security. So from Germany, when the charge comes to Indian employer, because he is seconded to India, both this charge India pays to Germany. Now the problem really comes whether it is taxable, that component. So just to put it into the number perspective, if his salary is 10,000 euro and he makes a 10% contribution to German social security, 1,000, and equal contribution is 1,000 also is being paid by employer. So what happens is when German employer sends a debit note to India, he will send a debit note of 10,000 as a basic salary and 1,000 as his contribution to social security. So 11,000 debit note will come, 11,000 euro debit note will come to Indian employer. And when Indian employer pays this 11,000, the point is whether 1,000 as an employer contribution or 1,000 as an employee contribution, because the employee is also paying out of this 10,000. So 2,000 is totally going to the German social security. Is it taxable? The real problem happens because we always try to compare Indian social security with a German social security or foreign social security. But because the nature with which the foreign social security really works, it is not taxable in India because there is no vesting. The benefit with which they get a social security back in foreign jurisdiction is not very similar to Indian PF. Indian PF, you get it back. It is just a saving. But a social security in Germany is not akin to PF. That is why we have a number of judgments. And please, sincere request for all of you to also refer to a technical guide by our own institute. There's a 2019 version. This is what has been given in the guide itself. Based on the various judgments, we have a clear-cut kind of a guidance that social security contribution, this 1,000 of employer and 1,000 of employee, is not taxable in India. So when you are computing the taxable amount in India, you consider only 9,000, exclude 1,000 of employer, exclude 1,000 of employee, and pay tax only on 9,000. This is what the social security. I'm trying to cover all my points. Let me go to the split residency. This is one more jargon, one more complex topics under the expat taxation. So what is split residency? See, I think what we understand is a person can be a resident of India or he can be a resident of USA or Germany. He cannot be a resident at the same time of both the countries. But understand a point that India follows April to June and many countries follows calendar year. So there is a inherent problem, first of all, in following a fiscal year, which is different in India and different in that other country jurisdiction. So what is split residency? Split residency is a concept where you are splitting the period within a period. So example, if some person comes to India or on let's say 1st of December 2022, he comes to India. And December, January, February, March salary is being paid. So logically, based on the, I think 1st of December would be a wrong example. Let's say he comes to India on 1st of October. So from October to March, because he is spending 182 days, he is a resident of India. And once he is a resident of India, he is resident for October also, November also, December also, January also, February also, March also. However, since he has come to India on October 22, unfortunately, he was in USA for 9 months and USA follows calendar year. So he is a resident of USA for calendar year 22, but he is a resident of India for financial year 22-23. I hope you are understanding the period conflict which I'm trying to explain. Let me explain again. He is a resident for a calendar year 22, for entire calendar year 22. He is a resident of India for financial year 22-23. So here there is a split period which is really happening. And to resolve this particular logic, OECD in paragraph 10, as well as fortunately, we do not have this split residency concept under Indian domestic law, but we have a judicial decision of split residency in this Delhi tribunal as well as this Bangalore tribunal. And I'm trying to explain you the logic with which it will work. So in this particular case, he will be considered as a resident of USA for the period April to September. As far as October, November, December, he will be considered as a non-resident in USA. In India, he will be considered as a resident only for October, November, and December. And why I'm saying it is important? Because once he is a resident, entire global income is taxable. But what I'm trying to tell you, that because of this split residency, he is resident only from October to March. He is not resident for April to September. Because he is not a resident for April to September, his global income, which is a USA income, will not be taxable in India. So in this case, how are we resolving this? April to September income will be taxable in USA, and only October to March income will be taxable in India. While he is filing the return in India as a resident for October to March, or for that matter, April to March, because India as a filing of return will consider April to March. But for the April to September period, because of the split residency concept, income from April to September will not be clubbed in Indian taxation. This is split residency. You will not find split residency concept under Domestic Income Tax Act. This is a concept of Article 4, sub-article 2, which is a tiebreaker concept rule. So tiebreaker, I think we have seen, you tiebreak permanent home, habitual abode, but that's a broad tiebreaker rule. We are here for a period tiebreaker. So we are tie-breaking the period also, and we are now trying to say only for the period he is resident of USA, and only for the period he is resident of India. I think that is how the tiebreaker rule is worked upon. This is an important concept. Please do not tell any US employee directly that your US salary will also be taxable in India. Please try to first look at whether a tiebreaker rule effective point is possible or not. USA means any non-resident for that matter. Let me now move to issue number 11. We saw that for short stay exemption under under the DTAA, there is a third condition which says it is not considered as a deductible expenditure or not borne by the PE in India. And I told you at that point of time, I have a very specific concept or issue here. What are we trying to talk about? So for a short stay exemption for a non-resident who is working in an Indian PE of a foreign company, if he is in India for less than 183 days, he will be allowed to get a short stay exemption or a DPS exemption. So the payer is a non-resident, condition satisfied. The person is less than 183 days, the condition is satisfied. But if there is a PE and in the profit computation, this salary has been deducted while computing the profit of the PE, then even though you are here in less than 183 days, unfortunately, you will not get the DPS exemption for that salary purpose. So please be careful when you are trying to avail the DPS short stay exemption. You have to be very sure why he is being paid that salary in India, which type of work he has done in India. And if the foreign employer has a PE in India, you have to ensure that that PE expenditure has not claimed this salary expenditure. Then and then only you get what I would say, a exemption for that DPS article. Otherwise, he will not get. So when you are trying to look at the three conditions under the DTAA, please be mindful of you understanding from the source and the activity of foreign employer in India, and the PE deductibility is not there. Then and then only you get. Only one fine point here. Few sections give a foreign employer a presumptive taxation. Section 44B, BB, BBB. There are few sections which, directly says that only 10% of the total gross receipts will be deemed to be an income in India. And in such a particular case, if the employer opts for such presumptive taxation, where is the direct evidence that this expenditure has been claimed, the salary expenditure has been claimed? So this was brought in front of the judiciary, and the judiciary has now categorically stated that even if there is a exemption or a presumptive taxation used by the employer, it will be deemed to have been considered that the salary has been deducted, and therefore this short stay exemption will not be available for the employee. So please be mindful of this short stay exemption. Very quickly on pension, I think we have been discussing on the salary, but as far as the pension is concerned, there are different rules. There is a different article which is applicable. So the article of DPS does not apply to pension. There is a separate article. And when there is a pension, in fact, there are two different articles most of the treaty has. One relates to non-government employees and the other one relates to the government employees. And as a rule, I have given here a logic. When the pension is given to a government employee, it is taxable in source. However, if it is the pension is given to the government employee, if he is a national of the state in which he is a resident. So let's say, and I have practically handled one case, that if a person is an Indian citizen, he is an Indian resident, but at some point of time he was working for Germany government, and later on now he is again settled in India. As a rule, as I said, once he gets a pension, it is taxable only in Germany. However, since this person is now residing in India and he is an Indian citizen, India will get a taxing right. So a different rule applies to a government pension. As far as private pension, it is taxed on residential basis. Social security, if at all, it is taxed on source basis. So I think I just wanted to highlight, when it is a pension, a different rule applies. I am on next point, very simple. Many of the time it so happens that a foreign employer ensures that a consultant in India is appointed to look at the taxation, to ensure that return have been filed, or if there is an assessment, then assessment is taken care of, because the poor employee who has come to work for a foreign employer is not fully aware of the Indian laws. And to ensure proper compliance, the consultant has been appointed at India. Now there is a problem that whether the consultant's remuneration, is it a 17-4 benefit? Because is it an expenditure which employee should have incurred but employer is paying, or is it employer only supposed to pay and then he is paying? So I think we have a court case to say very categorically, if the expenditure has been incurred on the consultant to ensure that the employer ensure everything has been taken care of properly, then it is the expenditure of employer, not employee, and therefore it will not form part of employee benefit, employee perquisite. You need not consider this as a taxable element in the salary of the foreign national. With this, I am coming to the last 2 points. Tax withholding in India. I think by now we know what is taxable, what is not taxable. Sometimes there is a problem that who should deduct the tax. I think that is the fundamental point. And many a time, if it is a PE, the point is very clear that the foreign national who has a PE in India should obtain TAN and should deduct tax. But the problem really comes when he is seconded or deputed to the Indian subsidiary. In that case, there is always a tussle as to who is the real employer, who should take a TAN, who should issue or who should ensure a compliance for tax deduction, filing return. So I think for that, I would request you to go to the Supreme Court judgment in Eli Lilly. I think this was a judgment where, very interesting. So this was a US company, France company or Dutch company, where employees were seconded to Indian company, and these employees were working exclusively for India. However, some salary was given in India, some salary was given in foreign country by foreign company. A issue came, and there was a survey which took place at the Indian company, from where the tax department came to know that there are two components, and Indian employer is only withholding the tax on the Indian component. But what happens to the foreign component? Because the entire 365 days, these employees are working within India. So can you really bifurcate foreign salary and Indian salary? And this is one very peculiar case where because of the fact the Supreme Court held that both Indian payments as well as foreign payments are taxable in India, because there was nothing which is done at foreign country. So services are rendered in India, and therefore whether it is received outside India or within India, it is taxable in India, and Indian employer should ensure withholding of tax. Very draconian, but please be mindful, all the employers, if someone who's from a tax department of a multinational company, please be careful to ensure a proper withholding of tax is taken care of. There is a lot of literature available within India, within OECD, that who should be an employer. But I think Eli Lilly will still overrule. And please be sure that you deduct the tax whenever payment is made in India or outside India. Please try to look at whether a payment made outside India is liable to be taxed within India as a salary. And once it is liable, you will have to deduct the tax. With this, let me come to the last point, which I said. The moment you want to take the benefit of a DTAA, unfortunately, section 90 subsection 4 states that a non-resident would be entitled to claim the benefit only if he submits TRC. Further, the TRC also has a format. If the details which are contemplated under section 95 read with rule 121B are not in TRC, then you are supposed to give form 10F. But in essence, what are we trying to say? That there is a condition attached to avail the particular benefit. This is as far as the Act is concerned. Once you have a TRC, of course, DPS article is applicable, pension article is applicable, and everything else. So please be mindful that you have a TRC when you are actually dealing with a cross-border employee, if you want to take the benefit. But as I said, there are always the rules. There are some exceptions. So we have these two case laws which comes handy. I would strongly recommend here that don't plan basis on these two case laws which I am citing here. These are the case laws which tries to say that section 90 subsection 4 will not overrule section 90 subsection 2, which is a beneficial rules section. I have my doubts how far you are going to get a benefit. So when you are in a planning stage or an execution stage, please ensure you have a valid TRC. In case possibly you are at a litigation stage, you can use this kind of a case laws. My personal view is section 90 subsection 4 does cast a responsibility to a non-resident before he wants to take the benefit, and please follow the rule scrupulously. I think with this, sorry, I think I have exceeded my time. I wanted to discuss with you 15 issues. I think I have made a justice. If you have some questions, I am happy to answer those questions. I can see 2 questions here. Should I take those 2 questions? Jigar has, sorry.
The question for you, you'll be able to visualize.
Sorry. I can read those questions in the Q&A box. Jigar,
Okay, sir. Okay, no problem.
I'll take it. So Jigar is trying to ask, please let us know how salary will be split if a person leaves India on 1st December, USA. He will be in India from April to December and from January. So it's the exactly reverse way which Jigar you are asking. I gave you an example, someone coming within India. Now you are giving an example, someone going outside India. So let's say, take a simple example again. So person is in India from April to November. Definitely he is a resident. There is no question. Now he is going to, let's say, USA on 1st of December. As far as USA is concerned, as for the month of December, he will not be considered for 1 month a resident in December in USA. So he will be a resident in USA from January onwards. And I'm assuming, let's say, 2022, from January to December, this person is in January to, in your example, January to November 2022, he is in India. On 1st December 22, he leaves to USA. If you look at our financial year for a moment, April to November, he is in India, he is a resident. I think there is no debate. As far as the month of December is concerned, he is outside India, but he is not a resident of USA. And therefore, this split residency will not help as far as the December salary is concerned. The moment January comes, he will be a resident of January 2023 now. So 23 calendar year, he will be a resident of USA. So for the month of January, February 23, February and March 23, that salary will not be considered in India, because in India, you are going to file a return April to March, but salary will be considered April to November of India, December of USA, but Jan, Feb, March will not be considered. I hope I have explained you this split residency concept. Second point again from Jigar, as per your explanation, I believe India will tax for the period April to December and US from Jan to December next year. I think you understood it correct, but it just put a context of the year. It is April to December 22, and from Jan 23, they will tax it. But this is a split residency. You will have to file the return and explain it. Next question, correct. Okay, so Jigar, I think I have explained your question. Next, I think let me try to look at some of the, I think there are no, is there any point which I have missed? Sorry, one new message. Okay. Jayesh is saying superb non-stop. Okay, thank you, Jayesh. Manoj is saying, yeah, Manoj, I think you had one question. Philippines not issuing TRC, how to claim DTAA benefit. I think my query number 15 has given you some indication. If you ask me, I am not in favor of those judgments. But if you are at a litigation stage, use those judgments. If you are at a compliance stage, please request for a TRC. And generally, you know, TRC also, the problem is it is a calendar year TRC. So if you want to cover the entire financial year, probably you will need 2 TRCs. Okay. Priyanka saying great session, excellent. Please cover full. Okay. Have I missed any question? I don't know. There is one raise of hand was there. I think somebody wants to say something.
Madam, can we unmute the participant?
Yeah, please go
Yes,
ahead.
sir, already unmute. Rohit, sir.
Hello.
Anybody wants to ask any
Sir,
question?
can you hear me?
Yes, sir, hear you.
Yeah. So regarding that TCS example which you had given me, when the employer is sent abroad for to the company from TCS India, same case I want to ask. Let's say when a company is there, it sends its employees, normally the engineers, abroad to its holding company to learn a certain process or something like that for 8 months, 9 months, and they come back to India to implement the process here. In this case, can we say this is an employment exercise out of India?
I have my doubt here, because the way the jurisprudence has developed looks difficult to say that his employment has been exercised outside India. But if we are saying that he has been given a duty to implement a new project in India, and for acquisition of that knowledge, he has gone outside India to gain that knowledge, you have a good case to argue to say that what was his employment. His employment was to implement this project. For this particular project he needed a skill. For acquisition of that skill he has gone out, and because of that his employment has been exercised outside India. I think you need to be little cautious here. Generally, whenever you have a clear-cut case of you working here and then you have been deputed to work on a project outside India, definitely yes. In this particular question which you have asked, I feel you have a good case to argue, but caution is definitely to be exercised.
Thank you. Thank you.
Okay, next. Any further question? I hope then I think I have understood or explained all the questions. I think there are no questions. Pranav, I believe.
Yes, I was also looking into the Q&A box.
Yeah.
And the chat box, but I also could not see it. But thank you so much, sir, for the excellent session. And the feedback what we are receiving from the participants is very excellent. So we are very thankful to you for such an elaborate session.
Thank you.
And looking forward to many more such sessions, sir.
Definitely. And good that since this is a no CP kind of session series which the Pune branch is conducting, I must first congratulate you and then to participants very honestly that even if this is no CP, but they are trying to understand something new. I think possibly this is nothing new, but this is definitely an area where lot of us are not venturing. Many of us feel that a normal chartered accountant cannot venture into this area. This area is only for some big firms. I don't think so. This is the right approach. Good that you are trying to learn. I would also strongly recommend you to do the diploma in international taxation, which our institute conducts. It's a fantastic course. It will give you a very good hands-on knowledge, including, let me tell you, the exam pattern in that particular course is quite difficult, but you should try it, which will give you a good hands-on knowledge, practical, theoretical, and then possibly you can also think about doing some international course. But straight away going to some international course, I would rather than recommend you do that diploma in international tax. I think that would certainly help. And once you attend such kind of a sessions or courses, you start developing, good kind of a knowledge and confidence. Even in my personal case, first 10 years of my practice, possibly I did not handle a single case which involved a DTAA. It was a foreign language for me. But the moment I got this opportunity, I did not waste it. Started with a very small kind of a queries, but I also developed interest. So please, sincere request to all of you who are attending, do develop, if you have a passion towards tax and very particularly international tax, I think please continue your study in the same passionate way. Thank you. Thanks, Pranav. Pranav, I think you are on mute.
So it is, if you permit, then we will upload it on the Pune website, Pune ICA website.
Yeah. Definitely. I think post this, I will send you this presentation and you can definitely
No problem, sir. Thank you. Thank you so much, sir, for the wonderful session.
Thank
And
you.
thank you so much for the participants also for the patient listening.
No, and interactive listening. Thank you.
And interactive. Absolutely,
Yeah.
absolutely.
Okay, bye-bye. Thank you. Bye-bye.
Thank you. Thank you so much. Yes.